Example of cash inflow and outflow. Let's look at cash inflow for regular business activities. First one will be cash sales on inventory. So basically a business sell inventories and collect cash on the spot. That's one regular business activity. There will be cash inflow. Next, collection of account receivables. Okay, the credit sales. You perform credit sales and 30 days down the road, okay, collect the money back from accounts receivable. This is part of the regular business activity. So some business would choose to have cash sales, some would have account receivables. It all depends on how the business management decide to run. Next, we look at cash outflow. The same, this one is look at regular business activities. So first one is purchase of materials. Okay, so you purchase material or purchase goods and finished products or raw materials. All this, yeah, you'll be cash outflow. You pay for all these things, right? Next, payment of wages. Okay, pay your salary. Pay cash to your workers. That's wages. Next, payment of interest on loans. Okay, you borrow money from banks. Yes, of course, you have to pay money back to the pay interest, make interest payment to the banks. Next, we look at irregular activities. Okay, business activity. That means this type of activities are not so common. Okay, not so common. Not that it's not normal. It's not right, but it's not so common. One, sales of common shares and preference shares. So this is probably rarely once a while. Then they'll issue. They sell common shares or preference shares. Okay, when company needs more money, they sometimes will generate. They'll issue more shares. Next, sales of bonds. Okay, so some company same thing. When company need money, okay, they need inflow of money, so they sell bonds to the public or institutions. So it's quite common. In this case, for example, recently SI issue more shares and more requires comfortable bonds also, issue more comfortable bonds. So this is a good example. Because they need more cash to tie through this difficult time of COVID-19. Okay, we are in a situation in this time that we are in COVID-19 situations and SI needed money badly. So they issue more shares and bonds. Okay, loans from financial institutions. The other way is that a business can borrow money from banks. Okay, so you won't borrow. You won't keep on increasing your bank loan. Okay, unless your company is expanding a lot. Okay, that's a different thing. But yeah, you do the companies when you need money, you do ask for banks for money. No, depreciation is a non-cash flow item. Okay, take note, depreciation. Okay, it just reduce the value of the car. Example, let's say car relate to a car. So you do not pay out any cash for depreciation. Let's say your car worth 100,000. Okay, and your this year the depreciation is 10,000. You pay out 10,000 out? No, don't pay out any cash out. Okay, it's a non-cash item. Next, for cash outflow, irregular business activity, you purchase fixed asset at various interval. So basically, here and there you buy. Okay, maybe 2 years down the road you buy another fixed asset because you need an event, because your business is expanding. Next, repayment of principal and loan. So basically, we pay back. Okay, you borrow money from the bank and you got to repay back. Okay, the principal. Payment of dividends. So basically, this depends on probably once a year. Then the company will give out dividends or may not give out dividends. It depends on the management. Payment of tax. This once a while, once a year, not like everyday basis. Okay, it depends. Okay, so it's not like on daily basis that you pay taxes. Not that. Next, share repurchase. So basically, the company have extra cash, and they want to buy their own shares. It's own shares. It's possible. So basically, not every time they will do such a thing, right? So, it's a once a while thing. All right. Any questions so far? The amount of cash balance and the marketable securities held are significantly influenced by the productions. Okay, so basically here we can see the productions here. You build up inventories, you produce the inventories, okay, that basically involve APP and AI. Next is the sales techniques and procedures for collecting accounts receivables and paying accounts payable. This influence can be better understood through analysis of the firm's operating cycle and cash conversion cycles. Okay, we'll refer to the illustration in the lecture notes below for a manufacturing firm Alpha for better understanding. So let's say on the first day, okay, the very first day, you buy the Alpha company, purchase raw material on account from suppliers, all these things, and you start to manufacture the product. Okay, go to production to manufacture the goods. Okay, and they sell the products, finished goods on account to customer. On the whole, from the first day to the day you sell the products, the finished goods, it took about 85 days. This is the AAI, okay, average age of inventory of 85 days. Next, it took another 70 days, okay, to collect the money back from the account receivables, right? So this is your average collection period, ACP, 70 days. Adding up the total, okay, 85 days plus 70 days give you 155 days. This is your operating cycle. Okay, so from this we know that OC equals to AAI plus ACP. Any questions so far? Right. The operating cycle is defined as the amount of time that elapses from the point at which the firms input material and labor into the production process, which indicates by this red arrow here, and at which the cash is up from this point to the point at which the cash is collected from the sales of the finished good products that contains production inputs, all the way to the end of the red arrow indicated from here. So you can see it stretches from the front operation cycle, start from the very first day and ends at the very last day until the point where the cash is collected from account receivables. Any question regarding operating cycle? At the day 35, okay, that's where the company pays off the accounts payable. So it takes 35 days for the Alpha company to pay the suppliers at day 35. This will be the APP. The remaining days will be known as cash conversion cycle. The formula is equals to OC minus APP, or the longer one will be AAI plus ACP minus APP. In this case, is 155 days minus 35 days gives you 120 days. Any questions so far for this? Cash conversion cycle, CCC, is the amount of time the firm's cash is tied up between 2 points. First point, payment for production inputs, which is shown in the red cash out, and the sales of the resulting finished product, which shows the blue point cash in, blue worded cash in. Any questions so far? Let us analyze this. In the ideal situation, a firm would like to collect the money first from debtors and pay the bills later to the creditors. This means that it will be a negative CCC for the firm, and the firm will be in a favorable position. However, it will be unfavorable to the creditors. For non-manufacturing firm, are more likely to have a negative CCC because they have generally carry smaller, faster moving inventories and often sell their products or services for cash. As a result, this firm's APP may exceed their OC. So in short, comparing non-manufacturing firm and manufacturing firm, this is the good thing about non-manufacturing firm. Okay. Next, we are moving on to manufacturing firm. For manufacturing firm, usually do not have negative CCC unless they extend their APP to an unreasonable length of time. So they extend APP so much that is look ridiculous and shorten their ACP. Unless they take extreme measures to extend the APP and shorten the ACP, right? Then they may have a negative CCC, but usually unlikely. Any questions so far?